Over the last decade, the private markets have seen an explosion of increased participation from non-traditional investors. With more and more investors flooding the space, companies are now able to raise larger sums of capital from private investors, allowing them to scale without having to turn to the public markets. With companies waiting longer to go public, private market trends have continued to evolve in ways that increasingly blur the lines between venture capital and private equity. One investment strategy that best captures this growing ambiguity is growth equity, one of the fastest growing segments in private equity. Growth equity investments target relatively mature, growth-oriented companies and typically take on a minority stake. Lying somewhere between private equity and venture capital, growth equity incorporates aspects of both, providing an attractive risk-reward opportunity for limited partners.
Some of the benefits associated with investing in growth equity include avoiding some of the downside risk of investing in earlier stage venture companies. You also are not using debt like you would in a buyout and are in some cases investing less equity than you would in a buyout for a similarly sized company. So this again mitigates downside risk. At the same time, you're then exposing yourself to the upside of these companies that are still growing quite rapidly.
Because of these advantages, growth equity has risen to be a standalone private market strategy. According to PitchBook, growth equity funds raised twice as much capital between 2016 and 2020 as they did between 2011 and 2015, which is roughly in line with the expansion of private equity as a whole, showing how growth equity has earned an established place in LP portfolios. But what is driving this growth?
So there are a couple of reasons why growth equity has become increasingly popular over the past several years. One is that venture has broadly outperformed other asset classes over that time period, and growth equity allows investors to get some increased exposure to that type of return while still mitigating some of that downside risk that you would have with pure venture. Another reason is that private equity as a whole has become a lot more oriented toward tech and tech-related sectors in recent years. So as firms start to build expertise in looking at tech companies, emerging technologies, you're seeing more growth equity investments out of buyout funds, more growth equity funds being raised by generalist firms, and just more awareness of and interest in the space as a whole. And finally, growth equity is highly flexible. So while the typical growth equity investment that you would think of might be a company that's gone through a couple of venture rounds and now is bringing in PE growth investors, you can also see growth equity investments being made in much more mature companies, especially if they are about to launch a new strategy or make an acquisition or they're pre-IPO. So it can be used in a number of different scenarios.
Another trend gaining in popularity is venture debt. Venture debt, or venture lending, is a type of short to medium-term debt financing provided to venture-backed companies by specialized banks or non-bank lenders to fund growth and capital expenses. Over the last decade, venture debt has emerged as a major alternative source of financing for high-growth VC startups, growing at a faster pace than the broader venture capital market itself. According to PitchBook, more than $80 billion in loans and other debt products were created for VC-backed companies in the US between 2018 and 2020, compared to just over $47 billion in the 3 years prior. Debt financing can be risky, as it could raise red flags for potential investors. But in recent years, that risk has lessened as the benefits of venture debt have begun to outweigh the negative perceptions of the past.
Venture debt is a great source of non-dilutive capital for companies and founders raising in today's market. Especially as companies are raising more larger rounds, this non-dilutive capital is a great way for those founders and their employees to continue holding a stake in the company. Taking out a venture loan is not a strict alternative to an equity raise, but it is a way for companies to make sure they have an insurance policy in addition to that equity that they raise to make sure that they're able to get to that next goal. An additional benefit to venture loans is the relatively inexpensive cost of capital that it gives these companies. With interest rates so low as they are today, these companies are able to raise a good amount of capital and be able to pay that back over the next few years without needing to sell an entire stake in their company to the investors, which could be worth billions of dollars down the road.
The growth of venture debt has largely coincided with the growth of the private markets overall. More companies receiving VC funding means more potential borrowers for lenders. According to PitchBook, the number of venture debt loans more than tripled over the last decade, going from 940 loans in 2010 to a whopping 2,900 loans in 2020. In addition to an increase in the overall number of venture loans, large late-stage venture loans have heavily contributed to a surge in loan value. According to PitchBook, from 2009 to 2020, late-stage venture loans grew more than 2.5 times and exploded over that time by nearly $17 billion in annual value.
Just as we're seeing mega deals in the VC equity market boost overall deal values, several large outsized loans are really going to have a major impact on the loan value that we're seeing in the market today. That being said, there has been a huge growth in the number of loan financings that we're seeing taken out by VC-backed companies. This is in part due to a growth in the understanding and knowledge of the benefits that venture debt has for VC-backed companies, but also because we're seeing more lenders stepping into the market and providing loans to companies where in the past they have seen as too risky. Another thing we're seeing that is helping boost venture lending is that the growth of the VC late stage is providing plenty of opportunities for lenders to come in and lend to companies that have a much lower risk profile because they have a really strong investor backing already. The growth of SaaS and other recurring revenue business models has also been a major boost to lenders. These models make it easy for these lenders to quickly estimate and model out the payback schedules of their loans, helping decrease the risk of lending to these VC-backed companies.
The private markets have grown and matured over the last decade. While this has created new options for investors and companies like growth equity and venture debt, how viable will these high-growth segments be in the long run?
So looking forward, we believe growth equity is going to continue to expand in popularity. This will be driven not only by the broader growth of private markets and expanding allocations to private equity more broadly, but also the growth of the venture ecosystem, which produces a steady stream of companies that are good candidates for growth equity investments. The public markets and the strength of the public markets right now are also going to be a driver of growth in this space as it presents just another favorable exit opportunity for growth stage companies. We're also expecting to continue to see larger private equity firms, generalist firms, established firms launching specific growth equity strategies, whether that's in biotech, clean tech, software, or another high growth area. Alongside that, we're also seeing, and we're likely to continue to see, new firms entering the market, raising their first funds focused on these areas.
We believe the venture lending market will see considerable growth over the next few years, likely mirroring the overall growth of the venture capital market in the US. Venture lending returns have been really strong and characterized by low loss rates, which is not what you would typically expect from lending to these VC-backed companies, which is going to bring more LPs looking for exposure to venture lending. There is a potential for interest rates to rise, though we don't believe a small rise will have a material impact on the venture lending market. Overall, venture capital has a lot of capital ready to be deployed, and there are a lot of companies moving through the venture lifecycle, both of which point to an increasing venture lending market as there will be more opportunities for lenders to get exposure to the VC asset class.
For more news and analysis, visit pitchbook.com.